Today, I want to spend a little bit of time talking about the municipal bond market. Those are sometimes referred to as tax-free bonds. Now, you may say, David, why are we talking about tax-free bonds? The stock market's been having a great run. Well, you probably know that there's an election going on this year, and we had our first date, and it was a little light on economic policies, but the future of tax policy, along with our efforts to address the deficit, could have broad implications for the municipal bond market. Some good, some not so good. And the election is going to go a long way in determining the future of tax policy here in the US, which will also likely impact determining future demand for munis. You probably have also heard that the Fed is about to start a rate cutting cycle, and the next few months could be the last best time to buy munis, regardless of changes to tax policy. So the Tax Cuts and Jobs Act, which became law in 2018, we can refer to it as the TCJA, is set to sunset in 2025. And similar to other temporary laws, the TCJA will need to be renewed through legislative action. So this legislation reduced top marginal income tax rates, expanded tax brackets, and encouraged corporate capital investment. If Trump wins the election and Congress is controlled by Republicans, many of these provisions are likely to be extended. If Democrats control the government, it becomes more likely that portions of this legislation will be allowed to expire or are going to change. So why does this matter? The TCJA reduced the top marginal income tax rate for individuals to 37% from 39.6%. If it sunset, the highest marginal rate would revert to 39.6%. Now keep in mind, we also have a 3.8% Affordable Care Act tax, sometimes referred to as the Obamacare tax. If you add that to the top marginal rate, it actually increases to 43.4% from the current 40.8%. Now, tax law doesn't necessarily impact yields on tax-free bonds, but it does impact the taxable equivalent yield of a bond. So a taxable equivalent yield means, hey, it allows us to compare apples to apples with corporate bonds or taxable bonds. So a taxable equivalent yield means what would we have to earn on a taxable bond, pay taxes on that income in order to earn an equivalent yield on a municipal bond. So the current yield on the Bloomberg Municipal Bond Index is around 3.4%. However, existing tax rates, taxable equivalent yield for that index is 5.8%, which is actually above long-term averages. If it expires and marginal rates increase to 43.4%, the taxable equivalent yield on that same 3.4% moves closer to 6%. And a muni bond's taxable equivalent yield increases as tax rates rise. So in other words, the tax exemption on muni bonds is more valuable for individuals who pay higher taxes. As such, it'd expect an increased demand for munis in a higher tax environment, all else being equal. Municipal bonds also have favorable fundamentals. Municipalities as a whole, in general, I should say, are usually in better shape. They have restrictions on how much they can borrow relative to their corporate or even US government counterparts. So if we add those favorable fundamentals, attractive starting yields, and the fact that the Fed is about to start a rate cutting cycle, I think the muni market is an attractive option for long-term investors as long as fixed income is an important part of your portfolio. So this all boils down to having the right asset allocation. Muni bonds aren't as helpful if they're in a retirement account because you don't get those benefits. So it's very specific to your situation, but I love muni bonds. I think they make a lot of sense for a lot of people. There's a lot of versions of municipal bonds that actually pay higher than 3.4%. So if you'd like to learn more or see if they might be an important part of your portfolio, reach out to us through our website, make a comment on this post, and hopefully you're finding this information helpful. But if we can help with anything else, please don't hesitate to reach out. Thanks.